Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, December 1st, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, futures are flat. Have the Dow futures down just a tad, maybe about 25 points. S&P 500 futures up 2, NASDAQ futures down 1. So very flat after a huge rally on Wednesday afternoon. We'll get into that in just a minute. Crude oil currently above $81 a barrel, so that's up a little more than 1% today. And we've got the 10-year Treasury yield down 10 basis points this morning to 3.60%. That continues a drop that began yesterday afternoon when we had a speech from Fed Chief Powell. I didn't hear it live, but I was listening, or I was going back and reading a little bit about what he had said. And honestly, I don't think he said a whole lot different than what, the Fed's been talking about. I mean, they've said they were going to lower, begin reducing the amount of the hikes. And so he just reiterated that. I think it was more a relief rally for the market, that he didn't drop some other bomb, that he didn't, go on to say, hey, we don't see a letdown in inflation and we could, have to raise rates for a long time. I think it was more of a relief that he didn't go in that direction. Because again, I didn't really see anything that suggested that they were changing anything. They've already told everyone that they're, looking to slow down the pace of the hikes, and they were checking out data. They wanted to see a series of reports that indicated that inflation was getting under control. And I don't think any of that really changed. So again, I think it was just a relief rally. It was actually another indication why I think the bond market, it's better looking at the reaction in the bond market than it is the stock market. And I'll talk about that more in just a bit. Let's go through and talk about the agenda for today. So I'll start off with the daily market recap, then talking technically, break it down. I'm going to look a little bit at technology today, then earnings spotlight, excuse me, and then the 3 you must see to wrap up the show. Before I get into that, let's take a look over at earningsbeats.com, mostly for those of you that are new to Earnings Beats. Welcome to the show. If you go to our website at earningsbeats.com and scroll down, you will find an area where you can sign up for our free Earnings Beats Digest newsletter 3 times a week, Mondays, Wednesdays, Fridays. No credit card required, just a name, email address, hit that subscribe button. We do have free events from time to time. You need to be registered as an Earnings Beats Digest subscriber in order to get the invitation to the rooms that we use for our free events. So please make sure you check that out. I think you'll really enjoy the digest articles. I try to make them very educational. So please check that out. Go to earningsbeats.com. Make sure you sign up for that. All right, let's jump in here to the daily market recap. And it was quite an afternoon. The market really did nothing until 1:30. It was really just sideways action like it's been, at least on the NASDAQ recently. There's just been no excitement, nothing really getting the market going to the upside. Those NASDAQ stocks, the growth-oriented areas, really have just been drifting to the downside on a relative basis. And that all changed yesterday at 1:30 Eastern. So the last 2.5 hours of the trading day is where all the gains came in. Dow Jones Industrial Average finished up 737 points, up more than 2%. S&P 500 up 122 points, more than 3%. And the NASDAQ jumped 484 points, which was 4.4%. So clearly the best reaction among our major indices. Mid caps up 2.33%, small caps up a little more than 2.4%. All of them were down close to the 20-day moving average. And in the case of the NASDAQ, I mean, we were near price support, weren't far from gap support. We were just below the 20, just above the 50. It was really important for the NASDAQ to do what it did yesterday to kind of right the ship back to the upside. But check out the AD lines, because outside of the NASDAQ, things are really starting to look up. The Dow Jones, a new all-time high on its AD line. I mean, think about that for a minute. If you know how the AD line's calculated, it's really how you finish in a day relative to where you traded during the day. If you're trading above the midpoint, if you close above the midpoint of that day's candlestick, it's a net positive to your AD line. The volume becomes a multiplier. And then depending on where you finish, if you finish at the very top high of the day, then you're going to get all of the volume basically added on. Well, look at the volume on the Dow. Look at the volume across the board yesterday. When we have seen volume over the last few months, we've generally seen rising prices. Price volume, there's really no substitute. And I was actually talking about that on my show yesterday. I was getting a little nervous because a lot of my sustainability ratios, a lot of the growth versus value ratios had been declining. Really after, well, we had the October CPI out on November 10th, and I think we went up and the growth was outperforming for about 4 trading days. And then probably the last 8 or 10 trading days, we've been going down in those ratios. But the bond market, our yields have not really gone up that much, nowhere near where we were before. So the bond market's telling us growth is the way to go, but the stock market's saying, well, we don't know, growth's been underperforming. So I was looking for some clarity with the Fed. Is the Fed going, I was thinking going into the meeting yesterday, is the Fed going to say something like they did back in August, the Jackson Hole speech, where Fed Chief Powell said more pain ahead, started editorializing a little bit. I was wondering, okay, are we going to get that? We're going to have another drop in the market? Or was the bond market right again, and the stock market, the money rotating out of growth, was that more fear, and maybe more of all the media coverage, the attention that the Fed meeting was getting, and of course, everything regarding inflation and so forth. There was a disparity there between what was going on in the bond market and what was going on in the stock market. Well, after the Fed meeting yesterday, there's no disparity anymore. Growth came roaring back. And now we've got the yield dropping this morning, another 10 basis points to a new recent low, down around 360. I said once we lost the 50-day and we were downtrending, I thought 350 was going to be the next key area of support for the yield, 10-year Treasury yield. And so being down 10 this morning at 360, we're getting closer and closer to that 350 level. I would suspect if we get down to 350, 348, 350, we're going to see a bounce from there. We'll talk about that in just a minute. But anyway, overall was a great day for the major indices. And I think you really have to pay attention to what's going on with these AD lines. The last 2 secular bear markets, when we were halfway in and we took another big turn to the downside, these AD lines went straight through the floor. That is not appearing to be the case. Even with the NASDAQ as weak as it's been, its AD line, it wouldn't take much to see the AD line break out to another all-time high. The AD lines are not cooperating if you're on the bearish side. I'm just telling you, go back and look at history. AD lines tend to get hit very, very hard with that next push to the downside because it's distribution. That's what happens to the AD line during periods of distribution. We go down. All right. Among sectors, technology, the big winner yesterday, up 5%. We needed that. The big bounce off the 20-day. We were just below 130, which was price support. We were just below the 20-day moving average, which is right now 130.28. And we came roaring back. Not only roaring back to get back up above those key levels, but we actually took out the high in the month of November. So we closed out the month on the high, which I thought was very, very bullish, very strong last 2.5 hours yesterday. Communication services, same thing, took out the November high. Still got a little work to do to get above the October high, but one step at a time. We do see that AD line, which was so weak, now really beginning to strengthen on communication services. Industrials making another breakout, not nearly as strong And I'm actually, this shouldn't have been in here. I'm not sure why industrials were in here. Anyway, industrials did well, but industrials actually were one of the weakest areas. You can see discretionary had a pretty strong day, up 3.45%. Utilities up 2.5%. So across the board, all 11 sectors were up, but the three that did the best, the three that we're always looking for, that I'm always looking for leadership from during advances, we got that yesterday: technology, communication services, and discretionary. All right, 10-year Treasury yield. So this is where we finished yesterday. We were up, and if I show you the 10-minute, 5-day chart, I mean, we were just, again, meandering higher on the 10-year Treasury yield. If we look at the S&P 500, it was just meandering lower, and there's the 1:30 speech by Fed Chief Powell. And you can see what happened after 1:30. I mean, it was just incredible amount of buying and on an incredible level of volume. I mean, the price action was superb. We went up 130 points in 2.5 hours on the S&P 500. And this, by the way, unlike back earlier in the year when I was talking about manipulation, I think it started in May, where the market kind of held its own from May through just, where we were yesterday at 1:30 in the afternoon. We hadn't gone up a whole lot, hadn't gone down a whole lot. We were just kind of meandering for the last several months. But we had lots of gap downs. The net gap downs were still pretty staggering, and we had intraday buying. That buying intraday continued yesterday. This is not a gap up. This isn't manipulation. That's a lot of intraday buying. That's different than seeing the market gap up on news and then sell off all day. This makes me feel a whole lot better when I see this kind of intraday buying and accumulation. Just adds to the manipulation I've been talking about, where the market gaps down and then rallies back. In this case, we were moving lower. Here was a little gap down. There was one. But anyway, this was clearly buying, a lot of buying taking place yesterday afternoon. All right. So right now we're below the 20-day, below the 50-day. Clearly we are downtrending on the 10-year Treasury yield. And then again this morning, right now we're down 11 basis points, down to 3.59%. Here was that breakout around 350. So this is why I'm thinking if we go back down to 350, maybe that's an area where we'll take a quick pause or maybe turn back up again for a period of time. That could coincide with some market weakness. But for now, it looks like we're heading back down toward that 350 level, and that should be good overall for equities. All right, so let's move on to talking technically. And here I just like usually to take a look at the major indices and just see, from a price perspective, looking at PPOs, moving averages, and so forth, the configuration, are we trending higher? Are we trending lower? There is no doubt in my mind, and this is why I say, even if you're bearish, you should recognize when we're trading above, when the price configuration is bullish. And if you want to get bearish, at least wait for this to turn bearish. At least wait for price action to break down back below the 20-day moving average. Because here, yesterday, was another perfect example of why, in an uptrend, you buy on the 20-day moving average. We were right on it. 39.39 is where the 20-day moving average is. Yesterday's low was 39.38. We bounce off of moving averages during uptrends. During downtrends, when we're trending lower, I mean, this was a period of distribution. You can see we don't usually do too well when we get to the 20-day. We typically fail. End of March, I swear to this day, I think this was still options related because there were so many net in the money put premiums going into option expiration week. And so we had this big rally. I remember writing articles and talking during my shows that I didn't trust this rally at all. I didn't think it was going to last. Thought we were going lower again. And we did. Things have changed. I believe we're going higher. I've been saying it for the last 5 months. I thought the bottom was in. When I say that, I think it's for me, my strategy changes, my trading strategy. When I'm thinking we're going lower, during the first half of the year, I thought we were going to have a bear market. We had a bear market. That's a market where you pick spots, maybe options expiration to go long. But for the most part, you're cash. If you don't like to short, you're cash. If you do like to short, when you get these bounces near the 20-day moving average, that is when you have your best opportunities to short. Once the signal changes, and for me, the signal changed at that mid-June low. We ended up going down a little bit lower, but my strategy never changed. I approach this market as though we're in a bull market. So I'm not thinking about shorting at all. I will at times build up more cash when I think we're just a little bit too frothy, or when things start to break down like they did here. You got to rein in some of your bullishness until you get the configuration back on your side, which we've now seen here pretty much over the last 6 weeks. Doesn't matter whether you're bullish or bearish. You still should be at least considering what's going on, price action. And right now we're trending higher. We're bouncing off the 20-day. The 20 days above the 50-day. The PPO is positive. All those things are positives. We had a positive divergence on the weekly chart. That's telling me, at the time, it was telling me 4,300, 4,400 on the S&P. If we pull up the weekly chart, lower prices, higher PPO. What I look for is a 50-week test, 50-week SMA test, and a centerline test. Doesn't mean they'll fail, but that's where the momentum, that's where that positive divergence, in my opinion, what I like to call plays out or resets. So we reset the PPO at the center line. At that point, there's no momentum in either direction. When you're at the 0 line, your 12-period and 26-period moving averages are identical. So at that point, you reevaluate. Now, back when we saw this occur, we had the PPO above 4,200. We had the recent high at 4,300. So I thought maybe we'd move back toward that level. We're at about 40.80 right now. The 50-week is at 41.35. So we got another 55 points. And then we have a test from a longer-term perspective. Pretty big test. Now, all my signals that I used, everything I looked at back at the beginning of the year that suggested we were going lower, we don't have those issues anymore. They're gone. If anything, it's the other way. Sentiment, which was crazy bullish going into the beginning of the year, now is crazy bearish. Equity only put call ratios completely reset. I wanted to see that. We saw that really it began back in June, and it's actually gotten even better for the bulls. It's gotten more bearish, even though the market is up from where we were back in June. It was 36.36 back here. 40.80 now. I mean, still holding on to bearish thoughts 5 months later. 400 points higher. The Dow Jones. Let's pull up the Dow. Now, this has been the best performing. Oops. Let's do it this way. This has been the best performing index by far. But let's take a look 2 years. Look at where we were at the top, 37,000, where we were at the bottom, 28 and change. And look at where we are now, 34,589. We're a lot closer to the all-time high than we are the September 30 low, or even this low in October. It's a huge rally. Volume been pretty strong, which is a little bit uncharacteristic. Normally, we sell off panic, high volume, and come back up on a little bit lesser volume. There's a lot of buying. Look at the AD line, moving back to new highs. I mean, be bearish if you want. This is a two-way market. You can be bullish, you can be bearish. Everybody, you got a lot of folks on both sides. I like the side I'm on. We'll see what happens. The NASDAQ 100. So here, this one has not been performing as well. And this was what I was talking about yesterday in my show over at Earnings Beats. And by the way, if you don't know, my 9 to 9:30 shows here at StockCharts Tuesday and Thursday. Over at Earnings Beats, you can actually listen to the show on Monday and Wednesday if you come over there. I've got this Trading Places live. If you click on that, anytime after about 8:45 on Monday or Wednesday, you can come in. The show will start promptly at 9 o'clock. Same as here at StockCharts, and it'll run till basically 9:30, although sometimes I'll run over a little bit on that show. Anyhow, one of the things I was talking about in yesterday's show, we can see this 11.5 area. We went a little bit above it here in September and October, actually in October, on these reaction highs. And then we gapped up to 11.350. And then notice these pullbacks right to about 11.5. And we had been holding. Well, yesterday we closed at 11.503. And we also closed, if you can see it right there, just a little bit below the 20-day moving average. I'll shorten this chart so you can see that. Right here, just a little bit below the 20-day. So I was saying yesterday, we are at a point, we need to see this NASDAQ going. Well, at 1:30, I think you can see what happened. It got up and went. Massive volume, huge candle, closed on the high. I mean, these are bullish candlesticks. When you see that kind of volume on this kind of close on the high, and we've had a number of these. This was after the October CPI report came out. Look at those two. This one, big gap down, big rally. And even here where we had the gap up and the big sell-off, notice we came back up off of the bottom, basically to the middle of the candle. We really haven't had many bearish candlesticks. I would say this is probably one of the more bearish back on November 14th, just because we closed near the low of the day. Most of these have been pretty strong, and just look at that one yesterday. I mean, that's huge. Look at where we were down at the bottom in October. That was a poor CPI report. That was the September CPI report where we gapped down, and then everybody bought. Look at the volume. There's accumulation taking place. Why is, if we're going back down, why are we getting these big hollow candles, heavy volume, AD lines turning up? In my opinion, get past your biases. I know there's some of you out there think I'm biased to the bullish side. I'm just looking at my charts. I'm looking at my signals. This is the same guy that looked at my signals back at the beginning of January and said, be careful. This market looks like it could have a big drop. It's got everything set up. All it needs was a market breakdown, which we saw. And once we got the breakdown back in January, the rest was history. Now we've got signals pointing to the upside. All we need is positive price action, which is what we're getting. Be careful on the short side. Also, this is just a 10-day chart and 10 minutes intervals. So you've got, this is just a 10-minute candlestick chart. But you can see, again, this was yesterday from 1:30 on. The S&P 500 had been moving up. We drifted back down and then exploded in that final 2.5 hours. Now, 3 key sector ratios: technology versus the S&P, which admittedly was falling apart. That's why I was questioning what was going on in the market yesterday. Here you can see the XLK 10-day low versus the S&P. We were getting a little bit of a relief rally in the XLY prior to yesterday, mostly because Tesla and Amazon were so bad 2 weeks ago. They started to recover, so we got a little bit of relative strength. They did okay yesterday afternoon. They went along for the ride. Maybe from 1:30 to the end of the day, it was up. So they outperformed the S&P. But it was mostly sideways compared to the solid outperformance we saw in technology. And then also, here's communication services. So we were already performing pretty well in communication services. And then at 1:30, we just soared, took off. So that's where I was getting back to that AD line that was, looking pretty good on the XLC that I talked about at the beginning of the show. All of those things are adding up to me to suggest this market wants to go higher. All right, break it down. I mean, I just really want to go through this briefly. If you look at the sectors, first of all, technology has started to move higher over the last month. We need to get back through this 20-week EMA. Now, again, this is the relative performance. We need that back up above. If we can get that, I think we can continue to push higher, especially if the 10-year Treasury yield continues to drop. As that's been dropping, you can see this has been going up. And I think yesterday got another big boost. All right, so that's number one. Number two, as I look at some of these areas within technology, look at this is computer services. We are at a definitely multi-month, but really about a 1 year, maybe 1.5 year relative high in computer services. That's good. Semiconductors are back above their 20 week and strengthening. Again, with the lower interest rates, we are seeing a big surge in the semis. Let's go to software. Software still struggling, but definitely picking back up again. That's good. Electronic equipment really looks bullish here. Relative PPO strengthening. Computer hardware, this one's been pulling back, but it's been one of the strongest through the year. So we're seeing a little bit of rotation out of the group. I think it's still fine. Electronic components trending above that rising 20-week EMA. Telecom equipment improving, but been one of the weakest areas. And then the last one I wanted to show you was just renewable energy. Huge, huge rally on both an absolute and relative basis. Renewable energy looks good. All right, quick earnings spotlight. Just want to go through some of these earnings real quick with you, and maybe the last three I'll go over. Use those as the three you must see, so we can wrap the show up. But here is Dollar General. Give you update on this. Down 5%. I think it's got good support down around 235. So right now 243, still trading above the key support level. They did beat, from what I saw on their bottom line. CRM. This is Salesforce.com. Getting hit a little bit, down 7%, 149. It's got its support all the way down at 140, so it should be opening up well above support. Snowflake down 4% yesterday after hours and this morning, 137. So it looks like it's going to be right back down to where it was yesterday. Another big software name, Okta, up 17%. So this one looking really good. Back up to 62 and change. I think the key level is going to be this gap resistance near 70. All right, last three. Let's see. PSTG. Let's look at this one. This is in the hardware area. Up about 5%. It had come back, rallied nicely yesterday, 30.5. I think it's got some work to do. Needs clear 32.5. Next up is NTNX. This is Nutanix, up 4%. Trying to make that breakout. This one looks like it could actually break out. An open around 29.40, I would say, is very bullish on this one. And then the last one we have here is, let's look at Kroger, which reported this morning, up 3%, going to be up around 50.72. Looks like maybe 51.75 or so is the area to watch. All right, that's it for me. I appreciate everybody tuning in. Be back next week on Monday over at Earnings Beats for your next Trading Places Live. Have a great rest of your week, everyone. Enjoy the weekend. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.